The foundational agreement, established in 1974 between the US and Saudi Arabia, was designed to mandate that oil, the world's most critical commodity, be priced and settled exclusively in US dollars. This single mechanism created a $3 trillion per year external demand for the dollar, forcing every nation to hold US assets to secure energy. This system was the hidden engine of American financial dominance for 5 decades. Today, that engine has stalled. Saudi Arabia is actively negotiating non-dollar oil sales with China and has joined the BRICS Plus alliance, which collectively represents over 45% of global oil production. The structural premise, that oil equals dollars, is dissolving. The financial paradox is terminal. The dollar's value has decoupled from U.S. production and anchored itself to a geopolitical contract that has just expired. This is the financial historian, where money, power, and history collide. And nothing is ever as simple as it looks. The cost of oil will now be paid in the price of your cash. To understand this, we need to start earlier. The official end of the Bretton Woods system in 1971, when President Nixon severed the dollar's link to gold, created an unprecedented crisis of confidence. The dollar became a purely fiat currency, backed only by the full faith and credit of the U.S. government, which was rapidly depleting its gold reserves due to fiscal deficits and the Vietnam War. This collapse, known as the Nixon shock, demanded an immediate non-gold anchor for the dollar to maintain its global reserve status. The solution was geopolitical, not economic. The structural foundation of the Petrodollar system was established in 1974 through a series of secret agreements with Saudi Arabia, the world's largest oil exporter and the de facto leader of OPEC. The deal contained 2 essential symbiotic components. First, Saudi Arabia agreed to price all of its oil sales exclusively in US dollars. Second, Saudi Arabia agreed to recycle the enormous dollar surpluses, the petrodollars, back into U.S. government debt and financial assets. This was the real shift. The arrangement effectively substituted the price of gold for the price of oil as the dollar's global structural demand mechanism. The numbers told a different story. In the 1970s, the global economy was consuming approximately 50 million barrels of oil per day. By mandating dollar payment, the U.S. created guaranteed artificial demand. Every nation, Germany, Japan, Brazil, needed to purchase dollars first to buy oil. This constant demand flow propped up the dollar's value, allowing the U.S. to run persistent trade and budget deficits without experiencing the currency devaluation that would destroy other economies. The dollar's strength was directly proportional to the world's insatiable thirst for crude. The recycling mechanism was equally critical. By funneling hundreds of billions of petrodollars back into U.S. Treasury bonds and securities, the oil producers provided cheap capital to finance the U.S. national debt. This kept interest rates low, subsidized U.S. consumption, and fueled the massive growth of the U.S. financial sector. This symbiotic financial relationship, guaranteed oil payments in dollars and guaranteed reinvestment of those dollars, became the hidden subsidy for the entire American economy. Confidence became currency. The system established a profound power asymmetry. For any oil-consuming nation, challenging the dollar meant challenging its energy security. For any oil-producing nation, moving away from the dollar meant abandoning the security umbrella and financial access provided by the U.S. For decades, the political risk of defection outweighed the economic logic of diversification. Iran and Venezuela, under heavy U.S. sanctions, were the exceptions, attempting to use alternative currencies, but their actions were too small and politically isolated to threaten the core system. The cracks, however, were becoming structural. The U.S. weaponization of its financial system, through sanctions, reserve freezing, and swift exclusion, transformed the dollar from a neutral global utility into a geopolitical liability. For major trade partners, particularly China and the BRICS nations, the risk of holding dollar assets became too high. This established the conditions for the petrodollar's terminal failure. The sovereign risk associated with the dollar exceeded its transactional utility. The system was designed to prevent a fiat collapse, but its enforcement mechanism, geopolitics, became its undoing. The modern mechanics of the petrodollar's death are defined by the convergence of geopolitical realignment and decaying systemic infrastructure replacement. The immediate final trigger was the expiration and non-renewal of the U.S.-Saudi Security Pact in mid-2024, which had mandated the dollar-only oil sales for 50 years. This event formalized the end of the obligation, transforming a structural certainty into a volatile variable. The resulting shift is observed in bilateral trade agreements and the rise of the petroleum pact. China, the world's largest oil importer, has successfully signed multi-year oil supply contracts with Saudi Arabia, Russia, and Iran that are priced and settled in the Chinese yuan, RMB. Russia, facing Western sanctions, now conducts the vast majority of its energy trade with China and India using rubles, rupees, and RMB, entirely bypassing the dollar system. The institutional incentive is simple: risk mitigation. The illusion holds until it doesn't. The impact of this shift operates on the document liquidity dependencies of the dollar. When a country buys oil in RMB, it no longer needs to sell its local currency for dollars to pay for energy. This reduces global dollar demand for transaction purposes. More critically, the resulting RMB surplus is no longer guaranteed to be recycled into U.S. treasuries. It is invested into Chinese government bonds, infrastructure projects tied to the Belt and Road Initiative, or even potentially gold. This directly cuts off the cheap capital flow that subsidized the U.S. fiscal deficit for decades. The numbers are decisive. The share of the dollar in global central bank reserves has been declining, sinking below 58% in recent years, a direct consequence of this de-risking behavior. The rise of the Stade BRICS Plus coalition formalizes the opposition. With the inclusion of major oil producers like Saudi Arabia, the UAE, and Iran, the alliance now controls enough global energy supply to create a self-contained, non-dollar trading bloc. Their active push for a commodity-backed digital settlement instrument is an explicit attempt to create a neutral, politically unweaponized alternative to the dollar. Confidence decides who survives. For these nations, the financial survival toolkit involves eliminating the single point of failure represented by the U.S. Treasury and the Federal Reserve. The economic consequences for the U.S. are structural. The petrodollar system allowed the U.S. to export its inflation. By exporting dollars in exchange for real goods, oil, the U.S. effectively transferred the inflationary pressure of its budget deficits to the rest of the world. As the petrodollar dies, the demand for dollars decreases, and the dollars already issued begin to flow back home. This necessitates higher yields out on U.S. debt to attract buyers, leading to higher interest rates, increased cost of capital, and a direct inflationary pressure on the domestic economy. This is not a slow market shift. It is the forced internalization of decades of financial imbalances. The petrodollar was not merely a mechanism for buying oil. It was the mechanism that enabled America's permanent trade deficit without consequence. Its demise forces the U.S. economy to confront its fundamental, real-world productivity constraints. Markets enforce what politics avoids. The decades-long subsidy is over, and the reckoning will be paid through the domestic cost of living. The cost of geopolitical supremacy is the loss of financial hegemony. The inevitable consequence of the petrodollar's death is the systemic devaluation of cash and the end of the U.S. economy's extraordinary privilege. The petrodollar provided a constant external stabilizer for the U.S. dollar, essentially guaranteeing that money printed domestically would find a necessary home abroad. With that external demand removed, the trillions of dollars created via quantitative easing and sustained fiscal deficits now confront a real market devoid of the oil subsidy. This is the mandatory internalization of currency risk. The first victim is the U.S. bond market. The forced recycling of petrodollars secured constant, deep demand for U.S. treasuries, which allowed the U.S. government to run up a national debt that now exceeds $34 trillion. As the major oil producers and their trade partners divest from treasuries, the U.S. must attract new buyers through higher yield structures. This directly translates to increased interest rates for U.S. mortgages, corporate loans, and government borrowing, severely restricting economic activity. The financial system is now exposed to the true, unsubsidized cost of capital. What cannot be repaid will be rolled over, but the cost of the rollover is about to become exorbitant. The host dollar's purchasing power is next. The structural loss of external demand means the dollar must now adjust its value based purely on the U.S. trade balance and productivity. Since the U.S. runs a massive persistent trade deficit, meaning it consumes more than it produces, the fundamental economic pressure is for the dollar to devalue relative to the currencies of exporting nations like China, India, and Germany. The imported inflation will become acute. For the average American, this means the cost of nearly every imported good, electronics, automobiles, and commodities, will rise sharply, directly reducing the real value of their dollar-denominated cash savings. The structural reveal is that the petrodollar system was a mechanism for the U.S. to consume wealth it did not produce. Its demise forces a return to a harder, more constrained fiscal reality. The U.S. financial system, particularly its equity markets, have been operating with an artificial discount rate enabled by cheap foreign capital. As that capital evaporates, the refinancing dynamics. For corporate debt and the valuation multiples for large U.S. equities must adjust downwards, creating a sharp and sustained contraction in paper wealth. The ultimate destruction of cash stems from the government's inescapable dilemma. Faced with higher interest rates and a structurally weaker dollar, the only politically viable short-term solution for managing the massive national debt is a return to financial repression. Negative real interest rates. Maintained through inflationary monetary policy, the Federal Reserve's incentive will be to keep nominal interest rates below the real inflation rate, systematically devaluing the debt and, consequently, all cash and fixed income savings. Your cash is not being stolen. It is being systematically inflated away to manage the structural insolvency that the petrodollar once disguised. The process will be chaotic, driven by accelerating geopolitical shifts that reinforce the de-dollarization trend. As more nations adopt non-dollar payment systems like CEPS and M-Bridge, the final vestiges of the dollar's transactional necessity will disappear. This is not a cyclical correction. It is a permanent structural reordering of global finance, eliminating the most significant financial privilege the U.S. has enjoyed for 50 years. The era of debt-funded consumption is over. The U.S. dollar is now just another fiat currency, and that changes everything about your savings. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.